Hello, it's Rhonda Thomas, and we're just about to start Financial Accounting's Chapter 1 intro exercises. We finally have the Zoom video figured out, so hopefully this will work out just fine. Okay, so I'm going to share my screen. Okay, and okay. All right, I'm going to make this smaller and move that over. Okay, these are the 8 problems, the intro problems. I'll be sure to walk you through these for each chapter. And this is where I'll probably do most of the teaching to try to help you understand the concepts. So let's get started with something called the cost principle. You can always highlight it and you can read the definition. So when we are in accounting, we have to figure out, even if we have a lot of different numbers for something. So this is on April 29th. We always want to pay attention to lots of dates. Okay, we have to pay attention to dates and figures. So Upstate Metal Roofing extended an offer of $132,000 for land that had been priced for sale at $151,000. So a buyer is wanting to buy land. The seller offered it for $151,000, but the buyer wanted to pay $132,000. That was on May 29th. Then a few days later, on May 3rd, Upstate Metal Roofing accepted the seller's counter offer for $144,000. That's the key. The buyer and the seller, when they finally accept the offer, okay, that's the amount that we're going to record that land. Even though on November 1st, the land was assessed at a value of $216,000 for property tax purposes, we only use that to figure property tax on. And then even though they bought the property on May 3rd, they turned around and sold it in December. But that's why they made that investment, probably, to hopefully sell it later and make a profit, right? Or make a gain. So they would end up with a gain. But the initial amount to record the land onto the Upstate Metal Roofs records is $144,000, and that's the agreed upon amount. Okay, let's go ahead and whoop. All right, I am trying to find the best place for this to go. Let me see here. I guess I can go back with it. Okay. Put it somewhere over here or up here. That'll be fine. I think up there is fine. Okay, let's go to the next one. The accounting equation. Okay, assets equals liabilities plus equity. So if we have for year 2, so year 2, we have 506,000. Okay, I'm going to have to change these because this is an algorithm problem. So let me change this. Life changing is a motivational consulting business. At the end of the accounting period for year 2, Life Changing has assets of $673,000 and liabilities of $162,000. That leaves equity at $511,000. So I actually have a formula here in this cell that takes assets and subtracts liabilities to get equity. So the first equity of mine is $511,000. Now you're going to get different numbers on these algorithm problems, so you'll need to try to figure out how to calculate. So you just bring the liabilities to the asset side of the equation and subtract them, and you'll find your equity amount. Okay, now we're going to go to year 3. So stockholders' equity as of December 31st, 2000, year 3. Assuming the assets increased, okay, so I'm going to increase my assets. Okay, so I'm going to make them go up. I'm going to make this go up So you either going to increase your assets or decrease your assets. Okay, it just depends on what your version is saying. So I'm going to add 128,000 to my assets from the year before, and then the liabilities decreased by 39,000. Okay, so here I have a formula that's adding those two together. Here I have a formula that takes last year's liabilities in year 2 and subtracts the 39,000. Okay, so that gives us new liabilities of 123,000. And then we end up with equity of 678,000. So assets went up, liabilities went down, and equity increased. Okay, so this is very favorable about this company. Very favorable. Let's check our work, make sure we're all right. Okay, moving on to this one. This is, we have the same one. If it doesn't say algorithm or algo, then we have the same numbers. So reliable delivery service is owned and operated by Joyce Neff. The following transactions were completed by reliable delivery during January. Okay, so I'm going to move this over a little bit. And we have assets, liabilities. So the elements should be, in my opinion, assets, liabilities, equities, revenue, and expense. But they have divided the equities into common stock and dividends. But that's okay. So the first one is the asset increased by 50,000 and common stock increased by 50,000. So what this is saying is they received cash. So an asset of cash increased and a common stock, which should be equity, common stock increased. So each side of the accounting equation increased. Okay. The next one is paid. When you pay something, cash goes down. Okay, cash goes down. So, and we are going to, why did it go down? Because we paid for an expense. All right, so we're going to make an expense go up. More specifically, the advertising expense, and it increases. Okay, that's on the equity side of the balance sheet right now. We pay cash, an asset, specifically cash, goes down, so it decreases. Okay. Purchase supplies on account. We're getting supplies. So an asset, I like to call this prepaid supplies, to be honest. We're getting supplies that we have not paid for yet. So we are going to put them on account. So we need to pay those soon, but we don't have to pay them right this minute. All right, so we're going to create a liability for what we bought those supplies for, accounts payable. And when you buy something on account, you cause accounts payable to go up. Okay, billed customers. Anytime you see the words billed customers, I want you to think accounts receivable for delivery services. How? On account. Why would we send a bill to customers that we've already received cash from? The answer is we wouldn't. So we send a bill to a client so they know how much to pay us. So when we create the bills, we're actually making an asset go up called accounts receivable, and it increases. And we did a delivery service job, so we get to make the revenue go up. More specifically, delivery services fee, and it increases. Okay, and then the last one is receiving cash. Okay, receiving cash causes an asset, specifically cash, to go up. And why? We're receiving cash from who? Customers on account. So we just did customers on account, accounts receivable here, And now those customers are paying us some of it. They didn't pay all of it, but they're paying us some of it. So this is an asset, and this asset will go down because we're receiving the cash from those customers on account. Okay, you've got to get used to this. You've got to get used to this. You've got to get used to the language. Customers on account is always accounts receivable. Purchases on account is always accounts payable. Or if it says anything about a vendor or a creditor, it's always accounts payable. Okay, let's check our work, make sure we're good. Okay, remember in chapter 1, we haven't gotten into debits and credits yet. Okay, we have to put together statement of stockholders' equity. So to refresh your memory, we have 4 required financial statements. Okay, required. Okay, let me put those words here, if I can spell it. Required financial statements. It's the income statement, the statement of stockholders' equity, the balance sheet, and the statement of cash flows. Anytime you see the word statement in a financial statement title, it is for a period of time. The only one that doesn't have the word statement is balance sheet. It is for one day in time, and usually it's for the last day of a period, like the end of September or like the end of the year. We're going to create a statement of stockholders' equity. So I'm going to give myself more room here. And when you make a statement, I recommend you go get one to look at. It may not be exactly the same, but at least should give you something to model after. Okay, something to model after. So this is the statement of stockholders' equity for the month ending November. We're getting ready to do one for worldwide travel for the year ending July 31st. Now, before we begin with this stuff, I want to look at this. So this is the balance at the beginning of the year, and this is the balance at the end of the year. So I want to go start putting the puzzle pieces in. So this is kind of like putting the border around a puzzle that you're just about to do. So we're going to report for the whole year, and this is a fiscal year. A fiscal year is something other than the calendar year. So I'll put this down. It's a good note. Fiscal year. Is other is not the calendar year. Okay, calendar year is January through December. Okay, some businesses use January through December, but if they don't use the calendar year, then it's called the fiscal year. Okay, so their fiscal year ends July 31st. That means their fiscal year begins August 1st. So we've got those 2 dates in. Now I want to look for what are the balances. I don't know if this is here in this example. November must have been the first day of business. November must have been the first month of business. Okay, so we want August 1st. So it says common stock had a balance of 110,000 and retained earnings of 580,000 as of August 1st. So sometimes you got to look. There are the numbers that we're looking for. We want 110,000 and we want 580,000. Now I think you have different numbers than I do, and that's okay. So if I add these together, then you add across. So you're going to add this way and you're going to add this way. Okay, so we just got the beginning balances in. Now let's see, did we issue? Issue means to sell. Did we issue any additional stock? It says Sheldon LeCount invested an additional $63,000 in the business in exchange for common stock. So yes, more common stock was issued. You keep it under the common stock column. Okay, and you just put zeros in, and then this is going to be 63,000 if you add across. Notice the next piece is net income. Now, they didn't tell us what net income is, but they gave us the pieces that we could figure it out. So here in my spreadsheet, I've put 1,225,000 as the revenue, and we have 3 expenses to subtract, and those total expenses are 1,031,000. So this is going to be the net income. So let's pick net income for the year. Skip over to retained earnings, but you do need to put a 0 there. Skip to retained earnings, 194,000. 194,000 gets added across. The last one is dividends. It says 39,000 of dividends were paid during the year. Remember, dividends are payments of earnings to shareholders. So dividends will come out of retained earnings, just like net income went into retained earnings. And we're going to put this in as a negative. Now, if they say that it's wrong, you would change it. Okay. All right. So I'm going to put a negative 39 here. Now we're going to add down. And I went ahead and put this into a spreadsheet so that, okay, so my dividends are negative 39 on here. So I did get a little bit different problem. So let me put 39,000 here. Okay. So now we're going to add down. And we issued 63,000. So whoop, I got to fix that. Just a minute. I got to fix 63,000. I got to go back. There we go. Issued 63,000 additional. Oh, yes. Additional common stock. Common stock does not get combined with retained earnings. Okay, so this is your common stock, which you can abbreviate. Okay, common stock, retained earnings. And then this is the total. Okay, so it looks like we have 690,000. So now I'm ready to put my totals here. So 173,000. If you take beginning balance, add net income, and subtract dividends, 735,000. And if you do all these numbers together with this as a subtraction at the end, you should get 908. Now I tested it twice. Okay, so let's see. Hold on. Net income. Okay. Oh, I made an assumption about the amount. So let me go back. My fault. Office expense is 160,000. Miscellaneous expense is 80,000. So my total expense was 1,016,000. That gets subtracted. My net income is wrong. I didn't follow the information that I should have. So we actually have net income of 209,000. Okay. And so with that, I'm going to replace this. All right. And now this has got one too many zeros. Otherwise, that one should be right. It is. So the wrong ones were here. So now this one becomes 750,000 and the total is 923,000. So 750,000, 923,000. There we go. Okay, so be sure that you get all your information from all the pieces that you need. Okay, and like I said, I added them down. Okay, I added them down. And then I added them across. So this is representing adding vertically, and this one is representing adding horizontally, and they should come out to the same amount. Okay, the next one is going to involve a balance sheet. Okay, we've got several items here, and it would be good to get a balance sheet in front of your face. Okay, they have them in various order here. Okay, so there's no real order as to what they are. And then here's the cash dividends. Here's the retained earnings in the beginning. So we'll need that. So I'm going to tell you so I'm going to list all these. Fees earned is a revenue. Office expense is an expense. Miscellaneous expense is an expense. Wages expense is an expense. So that's really salary and wages. That's okay. Still represents an expense. You can abbreviate. Then we have accounts payable. Then we have accounts receivable. So accounts payable is a liability. Accounts receivable is an asset. Cash is an asset. Common stock is an equity. Land is an asset. Supplies is an asset. So it's good to label these things because it's these items that are going to show up on the balance sheet. Okay. So let's go ahead and start with cash. And I want to make sure that I have my numbers in correctly. So my cash is $254,705. My accounts receivable is $67,080. My supplies is $11,500. And my land is $307. Okay, so these should add down. So I'm going to go ahead and put these in. Accounts receivable, supplies, land, okay, and then here are my assets. Let's just check it, see if I'm right. So that's half of my balance sheet right there. Guess what the other half has to be? It has to be exactly the same, okay, because it's a balance sheet. So then we want to put our liabilities in, all right, and I've got to find the new value for that. Okay, so the new value for accounts payable is $23,955. Common stock has a value of $135,000. All right. Now retained earnings, be careful. Be careful. Okay, so let's figure retained earnings. All right, so the beginning balance in retained earnings, looky here. Retained earnings of August 1st were $259,000. So I'm going to key that in here, 259,000. Okay. All right. The net income. Well, I've got to figure net income over here. Okay. So our revenue is 958,260. 958,260. Office expense is 220,400. Miscellaneous is 19,165, and salary and wages expense is 459,965. So net income, here's how you do it. Net income is revenue minus these three expenses. So net income becomes 258,730, and I've got that brought into this formula here. Okay, so equals net income, and our dividends are $36,400. So I've got to change dividends into $36,400. Now here is retained earnings. Here is the balance on 7/31. So retained earnings is going to equal that amount. Okay, now when you add down, you get 640,285. Okay, so you can find the difference. We already knew what this was. We knew this was 23,955. We knew what the total for the balance sheet is. And so we could find this number, and we could actually find this number once we knew what this one is. So there's two ways to work this. Either find the unknown, or you can prove it by running it through revenue minus expenses gives us net income. We need net income to find what the new retaining earnings balance is. This is actually the more correct way to do it, instead of just finding out what the number is. Okay, so let's go ahead and put this in. 23,955. We want common stock and retained earnings. Okay, common stock for me is 135,000. Retained earnings is 481,330. So if I add these two together, it's 616,330. And if you add these two down, then you get, so I'll do another calculation. So equals these two here. Okay, and hold on just a minute. Let me go back. Equals sum. I want the sum of these two here. And this one. Okay, and this one. So we want, nope, just these two. Yep, they match. Okay, if they match, then you have a balanced balance sheet. Balance sheets must balance. This total assets must equal total liabilities and stockholders' equity. Okay, now we're going to do a little bit of what's called a ratio analysis. So we have financial statements, okay, financial statements that have numbers about a company. So we use ratio analysis to help us understand what's happening in the company. All right, so we have something called a ratio of liabilities to stockholders' equity. This is a division problem. If you have a ratio, you have a division problem. Open the spreadsheet. Okay, we're going to do a little calculation here. So this is year 3 and this is year 4. So be careful. Accounting likes to put the most current year on the furthest column to the left. Okay, so you don't get confused. This was last year, this is this year. So our formula for ratio of liabilities to stockholders' equity is to take the liability of 1 year and divide it by the equity of the same year. So here's what we're going to do. Let's go down to year 3 equals liabilities divided by equity for year 3. Okay. Now we're going to do it again. This one equals the total liabilities divided by the equities. So we went from 0.80 as a ratio to 0.95. Okay, so now we are going to bring that number back to here. So last year it was 0.80. Now mine is 0.95. Okay, so what this means is that our liabilities have gone up. And not only have they gone up from 1 year to the next. So last year the liabilities were 2,560,000. Now they're 4,275,000. Okay, so it's gone. This ratio has gone up, and that means that the creditor's risk has increased. Okay, so we have more liabilities than we had the year before, and the ratio has changed. The ratio has gone up. Okay, like I was saying, liabilities have gone up. So the creditor's risk has increased because we have more liabilities. And what this is saying is for every dollar we have in equity, we have, so last year for every dollar of equity, I'm going to put this down on my sheet here, just a second. So what this is saying is, so year 3, let's put this down. That way you can kind of understand year 3, every dollar of equity for every dollar of equity we had 80 cents of liabilities. So for every dollar of equity, have 80 cents in liabilities. So for every every dollar of equity, you can call it equity dollar of equity. That's usually the best way to say it. Okay, dollar of equity, we have 80 cents in liabilities. Okay, that was the year before. Okay, let's do this again now. For year 4, okay, for every dollar of equity, for every dollar of equity, we now have 95 cents. Woo! Okay, so we've increased our liability quite a bit. So for every dollar of equity, have 95 cents in liabilities. Yep. So liabilities. Very good. Okay, that's what that means. So that's probably a little unfavorable. Okay, it's unfavorable. Okay. All right, this next one, we're going to put together an income statement. Okay, an income statement. So we're going to get an income statement in front of our face. We're going to stack the windows here. All right, so here is an income statement that I've brought a copy of. Fees earned are at the top. That is your revenue. They list expenses next. They list them in descending order with miscellaneous last. Okay, and then they also list total expenses, okay, before they subtract. So here it is, an income statement. An income statement is for a period of time because it has the word statement in it. So I'm going to copy and bring this down. Okay, and the first one is fees earned. I have 1,495,000. Okay, so Okay, let's put this in 1 million. So you can go ahead and put, if you want to, go ahead and put your accounts in. It's okay. It doesn't matter if you don't, however it makes you feel better. Fees earned. The label is total expenses. I'm sorry, just expenses. Just expenses. Total expenses goes on the bottom. Okay, so just expenses. And if you don't spell it right, it'll fuss at you. So the first one is going to be office expense, miscellaneous expense. So you can copy it and put it in. You want to get you used to doing an income statement. Miscellaneous expense. Okay. Actually, I want to start over. I want to put in the biggest one first. So the biggest one is here, salary and wages. That's not surprising. Okay, salary and wages. Okay, salary and wages expense is 890,000. Oop, I forgot to put in our revenue. Revenue is 1,495,000. Okay, then the next one is the office expense for 305,000. The reason accountants like things in a certain order is the amount that they see at the top of the expenses list is their biggest expense. And there is some value to knowing that information. Okay, so you can type in miscellaneous or you can just copy it. $37,000 is what I have. Okay, so I'm going to go ahead and put in, this is for my income statement. Let me move this down just a little bit. Insert. Okay, so I'm going to put in 1,495,000, 890,000, 305, and 37,000. I let Excel do my work for me. All right, so this is going to be total expenses now. Remember, you total it, and I've got total of 1,232,000. Now, if you want help with how to put numbers in, you need to read what that income statement instructions say. It says enter amounts as positive numbers unless the amount is a calculation that results in a negative amount. So we're going to put this in as positive and it gets subtracted from the fees earned. Okay, so net income is 263,000. So net income is 263,000. All right, let's check our work. And we know that this net income will then go to the stockholders' equity statement. Okay, stockholders' equity statement. It will go in retained earnings because we need a number from income statement to do the statement of stockholders' equity. And then we need information from the stockholders' equity to do the balance sheet. Okay, last one. We're going to put together a quick statement of cash flows. Don't worry about this statement too much because we are going to devote a chapter to it when we're a little more down the road with some of the accounting. But I have put a statement of cash flows here. Okay, so what I want to start with is okay, so this is the year ending July 31st. So they put that in for us. So we received some cash, but notice we have operations, okay, operating section, investing section, financing section. Those three sections, we're going to evaluate what happened with cash in each of these three, but we get the cash balance on August 1st. So you'll want to put that in right here. So mine is 109,910. I'm going to put that right here. 109,910. I don't know what beginning cash is yet. Okay, so I'll be figuring it out. Okay, so cash received from customers. Let's see, cash received from customers. Looks like it goes in the operating section, and then cash paid for expenses and creditors gets subtracted. So let's give this a try. Cash received from customers, 275,840, and then we want cash paid for operating expenses. Doesn't look like we had any. All right, so this is going to be a negative amount. Cash paid for operating expenses, 228,950. Okay, so I'm going to fill this in so I can calculate what I need. So 275,840, and down went cash. Okay, so this section actually caused cash to go up by the net amount, the difference between those two. So this is net cash flows from operating activities. So we've got that one so far. Then it looks like our only investing activity was cash that was paid for land. And I've got 48,000. I'm going to put this in because this is cash going out. Okay, 48,000 cash paid for purchase of land. And this is going to be a negative, I believe. Okay. Cash flow from financing activities. So the only financing activities we have are the issuing the common stock and paying the dividends. Okay, so we always want to put in cash received first, positives before negatives. So cash issuing 19,300. Okay, 19,300. Then we have cash paid for dividends. Okay, cash paid for dividends is 3,700. So down 3,700 goes. Oops. So cash was received and went down. Okay, so I'm going to put this amount, these amounts in here. So it looks like the financing section had a positive impact. We have a positive number, a negative number, a positive number. So this is going to be net cash flows from financing activities. Now, we're going to add these three together. Okay, 46,840 from operating, negative 48,300 from investing, and 15,600. And when you add these three together, you get a net increase in cash. So cash actually is more at the end of the year than it was at the beginning. Okay, and it went up 14,190. Okay, we have to find the ending balance. Well, if this was the beginning balance, we add the net increase to it, right? So I can add those together. So I want to put, so the ending cash balance is equals the beginning cash balance plus the increase in cash. There it is. Okay, increase in cash, 124,100. Does that make sense? So let's check our work. Yes. So they had us find this ending balance. A lot of times they give us the beginning and the ending, so we can already figure out what that increase or decrease is going to be. And then we've got to make the cash flow statement add up to that. Okay, so we won't touch the cash flow statement until chapter 13 or 14 now. So you can say goodbye to this one. We'll do plenty more of income statements, statement of stockholders' equity, and balance sheets, though. Okay, so I'm going to stop my share and say goodbye for now. Thank you for waiting for the videos. Hopefully they turn out to be helpful. Okay, so I'm going to